Ron, in reading your piece yesterday, I actually read it today, you point out that this is not just a big piece of tonnage, but it represents a seismic shift in the way fiscal policy has been managed over the past several decades. Explain what you mean and why it's so important.
Well, I think, Tyler, as you accurately described it, we're going from about 40 years of trickle-down economic theory in which, tax cuts and other adjustments to fiscal policy were presumed to have started in the financial markets and made their way into the real economy and ultimately would lift the entire citizenry. Instead, we're going to bottoms-up budgeting, where we are seeing this particular plan, the relief effort put forth by President Biden, as something that addresses the underlying needs in the economy that have long been, I think, ignored. And that is for those who have fallen into poverty, those who are long-term unemployed, those who are women, minorities, or others who have been disproportionately affected by the pandemic from an economic perspective. That's being addressed. And when you add the stimulus that may well be coming from infrastructure, we've really reversed policies away from, again, trickle down to bottoms up. And I think that's important, again, not just because of the size, but the focus is now, I think, from a policy perspective, going to be much more on Main Street than on Wall Street relative to the last 40 years.
All right, let's turn to Alicia Levine and ask the key question here. Let's round third and bring it home. What does all this stimulus, and I mean all this stimulus, not just the fiscal side, but the monetary side, which continues apace as well, Alicia, what does it mean for equities this year and beyond?
Look, I agree with much of what Ron said, that this is really going to be about Main Street, particularly this year, and not so much about Wall Street. But we're very positive on the market. We think the market moves higher. The risk, as we know, is really in the rates market and with yields. And as long as yields can crawl higher and not leap higher, then the market should be okay and tech should be okay. You need to expect volatility in tech. You're going to have enormous swings to up 2%, 3%, down 3%, based on where rates are going. And we think ultimately, the Fed's going to have a tough time dancing on the head of a pin here, getting policy right. There's a lot of stimulus coming to the economy. Not all of it is replacement income this year. Arguably, replacement income is not inflationary, but the rest can be given the sizes that we had last year and this year. Very hard to get this right. It will be reflected in yields, and so you'll feel it in the tech trade because tech is the most vulnerable to spiking and rising yields here. However, we'd use those down days in tech to build positions.
Shepard Smith here. Thanks for watching CNBC on YouTube.